Hello, everyone, and welcome to today's keynote. My topic today is going to be on financial integration and climate risk. I'm Kristle Romero Cortés, and I'm an associate professor at the University of New South Wales in Sydney. Today's topic is important because we know a lot about financial integration, but in the light of the current trends for climate risk and climate finance, it's useful to review what we know and to see what we've learned and how it can be impacted by what looks to be a very important and strong trend going forward. So what is financial integration? It really means saving in one market and then an investment in another, right? So on its face value, it's a movement of money from areas that have excess in savings to areas that are really interesting for their investment opportunities that may not have the same savings potential. Now, why are there barriers to integration? Why doesn't this happen everywhere the same? Because there are frictions, right? So there could be actual legal requirements and frictions in place. And that could include such as we weren't able to have branching, or you're not able to have banks leave their core market. It could be something as simple as cultural. It may be that you have a very deep trust in your financial institution, and that same trust is not easy to replicate at an extension or at a different institution. Beyond that, you may see regulatory guidance in terms of what is considered acceptable from the central bank of the country. And then lastly, but definitely not least, is the information exchange and the monitoring options. So let's say there are ways that everything's legal so you can make investments. It's still a prudent investment because of the fact that you'll be interested in looking at what those options are moving forward. So there's changes to integration in the local financial markets. Clearly, in the 2000s, we saw a lot of securitization within the residential real estate market. So homes could be purchased with mortgages. Those mortgages were originated at one entity. However, they were able to be sold off to government-sponsored entities of the United States. And those GSEs, as we would call them, Fannie and Freddie, for example, they would be holding the mortgage on their balance sheets instead of the bank that originally originated them. So this has created a trend to potentially harden some information like credit scores or loan-to-value ratios, so that across these different institutions, you would have very similar looking products. You can also see that there was the extension of bank geographical domains with the deregulation in the 1970s and 80s within state, and then across states in the 1990s and the 2000s. And this is very stereotypical that we can look at these changes because they were regulatory regimes that shifted. But you can also learn a lot from this type of environment that could be extended outside the United States. So why should we care about financial integration? Simply, it is a massive part on how institutions are able to go about their daily business, right? So on one side, the institution itself needs this for business. On the second, we're seeing a lot of small businesses and medium-sized enterprises that require funding that have to come from traditional banking sources, and it's not as easy to get investment in an area if you're based off of simply the deposits available in that area. It's another thing to notice is that it can lower the cost of credit overall, right? So this could be very useful for the positive effects of after allowing deregulation of the branch networks. But you can also see this better allocation of capital meant that there was investments in positive NPV projects, right? And this is able to translate to economic growth at that local area and being able to potentially lower volatility and just have overall better risk sharing across the institutions and the economies, which then translates into healthier economies. And so it is true that there are risks involved, but there are a lot of large positive effects. So an additional thing that we can see is that competition is enhanced in these areas, right? So better managed banks are those that are able to thrive and thus they grow. And you can see that rents are reduced across the sector, and potentially considering then you would actually see more firm entry, right? Now, it's possible though that the capital flows more easily across local markets, it will lead to better quality investment, but you always have to be concerned about where it's coming from. So our specific research questions when I set out for this project, which is joint work in academic paper, shows that does the supply of credit decline when banks reallocate this credit to markets with high credit demand? So in the example that I'm going to be looking at for the study is that we'll look at specifically areas that were hit recently by a natural disaster. So this has increased the credit demand in that area. So it is evident that area needs to have credit, and there will be a flow of supply of credit to that area. But the question is, what happens to the other areas that are connected via a financial network to the areas that were in fact affected by the natural disaster? So to focus on this research question, we look at small banks, those considered to have less than 2 billion in assets. We do this because it's important that we're able to watch specifically the internal capital markets of a bank. And very large banks obviously have a lot going on. So we look at the smaller banks, which were able to follow the flow of that capital more closely. And another important thing to take away is that we have to, in a way, shock that market in order to have that increase of credit demand. And some natural disasters, although albeit are very large, they're still relatively small in comparison to the largest banks' asset portfolios. So we then move on and look at the difference in behavior when a market is considered a core market for that bank, or potentially a non-core market, and across different types of loan characteristics, so either more or less liquid loans. We find that credit in the non-shocked but connected markets declines by either 25 to 50 cents per dollar of additional lending to the shocked areas. So this is an important finding, because this means that it is in fact the case that credit is constrained to the areas that are connected to those that were hit by natural disasters. One would expect they had no control over the fact that they were connected to areas, and while the areas that were shocked had no control of the disasters themselves, they're the ones that received the credit at least. So all of the decline comes from loans in areas where banks, though, do not have branches, i.e. in non-core markets. So this is another finding that's important to really emphasize or prioritize the impact of having a core market setup for a bank, recognizing and prioritizing its market, even though it will be moving capital internally. There are going to be rank order importance of markets in terms of priority. So banks increase the interest rate on short-term deposits to attract funding in the non-shocked areas. So it means that they are genuinely behaving in a way to kind of cover these costs in order to be able to increase the credit supply in the areas that were shocked. Now, the underlying premise is those areas and all areas that are hit by natural disasters have potential positive NPV projects. And what does that mean? It means that we can move credit there knowing that this credit is going to be repaid. The fact is they need the money now, not because of some sort of long-run economic slump, but rather a very short-term shock that has occurred because of something like a hurricane or a tornado. And something to be noted is while we stay agnostic on natural disasters themselves, obviously they are horrible, but they are able to be used in this setting because while it's possible to know that you're in Tornado Alley or you live on the Gulf Coast, you don't know exactly when a disaster will hit. And this provides for really useful strategies for us to be able to then say the shock itself is what increased the demand for credit, and the banks themselves then responded in a certain way, which means in normal times, they are also most likely still acting this way, that they do in fact move money around their markets, but when they do this, they would shield their core markets. So what we use in terms of the strategy to be able to claim causality, it's something we're able to say that this caused something else, is that we need, for example, if we have two banks, a bank A and a bank B, they both have the credit demand conditions in their common non-shocked markets, right? So they're in both markets, but only bank A is actually in a market that's hit by the natural disaster. Then we're able to compare across those two what's going to happen across then both of their markets. So in this figure, we show that natural disasters from 2001 to 2010 occur across all of the continental United States, right? So while it's true that there are certain areas that receive much more intensity, and obviously if we had done this in the last decade, you are going to see that overall these are going to be much darker in colors because the intensity of disasters and frequency of disasters has been increasing. But needless to say, overall, we see that there is an effect across many different regions, which is useful because this helps us identify across all the different markets the potential for being able to have things that are specific just to that market, right? So what we will do is that we'll look only within those markets so that we're able to include what's happening with that market, but not necessarily muddy the waters with what's happening in other areas of the country at the same time. So if we just look at a very overall kind of plot of what would be happening, we see that bank credit demand does definitely rise after a natural disaster. So this is able to be replicated across different countries, across different data sets, and it's not a long-term type of a shock. It's true that where a disaster hits, there's a very acute increase in demand for loans and lending at that time. And then it eventually does taper back off and return to kind of before disaster time period. And this is useful to just reiterate in the areas that are shocked, they do in fact need to have bank lending meet this increase in demand that's kind of, in a way, come out of nowhere. So what we'll use in addition to the strategies described before is that we need to define the markets that are actually hit by a disaster and the markets that are connected to those via their bank network, right? So we'll be doing this at the level of both the bank, the county in the United States, and the month. Within each of those levels. So we will be looking within the bank, within county, within month. When we are able to identify the shock markets, the ones that are hit by natural disasters, we then drop them from the regression because they effectively are allowing us to test a placebo to make sure that in the areas that needed the lending, they received the lending, but they're not themselves the ones that are connected to other shocked markets. So we finally end up with a non-shocked connected market sample, right? So the bank must have made loans in the prior year, not hit by a disaster. And then we were able to identify if a bank had a branch in that market, which translates into either being a core or non-core market. Once we do this, we can aggregate up all new mortgage originations in this connected and non-shocked county by bank county month. Okay, so we're looking at all new originations in residential real estate to address the idea of new credit that's being lent into an area. And again, the shock itself is happening in the disaster affected markets, but we're able to measure then lending in the shocked counties and an exposure to this lending to the connected counties. So we must be able to locate lending, to be able to locate the identity of the lender, and to be able to do this, we use data that includes both of these, the address of the actual where the lending goes to, as well as the bank itself. This comes from HMDA data, or what was considered residential real estate data in the United States. It also includes that breakdown between loans that are conforming or non-conforming, otherwise known as jumbo or non-jumbo, so that it could potentially be securitized to one of the GSEs. Since this is monthly data for the natural disasters, we then are able to create a panel from 2001 to 2010 of all of the counties that are hit by a disaster that receive money from FEMA. So these are very large disasters. But then additionally, we see the monthly mortgage data coming from HMDA going towards all of those areas. And the FDIC summary deposit data will give us where every geographical location of every bank branch. So again, we drop the large banks, so anything with assets above 2 billion, and we focus on the small bank sample in order to really identify the internal capital markets of banks. This is what's interesting, is that even though we have the need or the clarification that we expect these disasters to have received money from FEMA, you're still going to see that they're covering many states, and that you're going to see the property damage in the hardest hit counties is in the billions. So whether it was hurricanes, wildfires, floods, again, you effectively have an option to really include a lot of different regions in this type of analysis. What we'll see eventually in our regression is going to look at that changes in the monthly mortgage originations. So some of the data that's interesting to really look at is that in an area that was exposed to a disaster, which implies that you have about a 12.4% faster growth in those shocked markets. So money is genuinely flowing to that area to really rebuild after this disaster. And again, we're looking at banks below the size cutoff of 2 billion, but you still end up with a large heterogeneity across the banking sample as well. So to conclude, there are negative effects of natural disasters that are shared across all these financially linked markets, right? The financial resources flow in from unaffected areas. Securitization itself actually does aid in the fact that they're able to fund new lending, because we see that there is an increase in securitization in order to recoup some of that funding. And again, the multi-market banks fully shield their core market. So this effect really comes from areas where banks do not have branches, where when they are themselves financially constrained because they are effectively responding to an unexpected shock, they do not want to decrease lending in areas where they have the market share with the branch, and instead they will decrease and cut their credit to the other areas where they do not have a branch. So I just want to stop the slides there, but to kind of reiterate the fact that while this is happening within the US or regardless of the sample itself, what we're seeing is an increase in the need for financial institutions to address issues that come from climate change and climate updating. So whether it be physical risk or transition risk, many central banks are looking at how they can fully appreciate the financial institutions' needs when they're addressing the underlying needs of their borrowers, who are usually updating themselves on a day-to-day basis for the increasing need to appreciate the changes as we move towards kind of a new normal. And one of the things to iterate on this is the need for financial institutions to really have the flexibility to be able to help out, but also then for us to do the type of research that we appreciate exactly what is happening within their internal capital markets, so that borrowers are able to access credit when they need it. We're able to really fully give and support the resilience efforts of areas that are hit by specific natural disasters, but then also to build a more resilient economy going forward that includes all sorts of institutions, whether they be governments, whether they be private institutions, and then of course households. So with that, I'd like to conclude. And again, thank you very much for having me for this talk.